we're moving on to the next subject, which is about 1031 exchange in real estate development.
Okay, so what is a 1031 exchange?
Well, a 1031 exchange is a situation where if you have a real estate sale and you have capital gains on the real estate sale, the IRS allows you to trade that real estate for another purchase, the money from the first sale, to a new purchase without paying capital gains tax on it.
Right.
But you have a short period of time to do it. You have to identify it within 45, and you have to complete it within 180 days.
Right.
And if you don't do that, then the IRS can come back to you and charge you capital gains tax on the difference of your purchase and the stepped-up basis for the sale of the real property.
Right. And what's kind of interesting, capital gains, I think it went up 7% from the 15, and plus there may be, you could get it with another 3.8%. So I think that would be 25.8%.
Well, the 3.8% you're talking about is actually part of what was brought in the Affordable Care Act.
Right.
And that was one of the clauses that we had to read after we passed it.
That one was never delayed.
That was never delayed. And the 3.8% sales tax on the sale of property for really interesting how that is, because that means that instead of the straight exclusion of no sales tax on your property, we now have a 3.8% sales tax on sales of real property before, which were excluded.
Well, what happens with this is a DST, is a Delaware Statutory Trust, and what happens with the Delaware Statutory Trust is that several people can kind of join together. And they used to do, it used to be a tenants in common, you do this.
Right.
But the problem with the tenants in common is that the bank, when it was giving out a loan, it would have to deal with each individual investor. So let's say you have a pool of investors who all want to throw in some money to buy something that individually they wouldn't be able to afford, like they want to buy an apartment complex or something. So the Delaware Statutory Trust helps them do that. And let's say, for example, you live someplace freezing cold, or the taxes are going up like New York, and you say, well, I want to move to Florida, and you want to retire. When you sell your New York property, you're cash rich, but you're going to be hit with whatever this is. I'm not sure of the exact number, but I think maybe a 26% capital gains.
Right.
But if you do a 1031, but you might not be able to live or move, or move your commercial property, because this would be the DST is just for commercial. It's not for your primary residence. But if you want to move your investment down somewhere, or let's say you were managing something and you just tired of managing it and you wanted to throw in with a bunch of people and hire a property manager, this gives people, a different mode than doing a tenancy in common. Okay,
well, so then my question is, at this point then, what you're saying is non-real, non-property that you live in, this would be commercial property, and now you can have groups come together and put money together. Individuals put money together so that they can utilize a 1031 trust to be able to buy a commercial property without having to pay capital gains on the properties they sold to earn that money.
Essentially, you would use the 1031 exchange, but you would bind together with other people, and so there's kind of brokers that help you meet those people that are under the same time constraint, and then maybe you would delay or speed up your sale of your property so you're in with this next batch.
What other restrictions are there?
As far as...
Are there other restrictions between the combination of the players that want to come in and put their monies together?
Well, there is, you might have an upfront load of up to 10%. So you might have to put in some money up front. Also, for commercial properties, for a yearly fee, you might have 1% yearly fee. Or for a multifamily, you might have a 4% yearly fee. So you've got some fees and upfront costs that come in.
But are those recurring?
The yearly fee would be, yeah.
Yearly fee is recurring.
Right.
And so is that a fee that's paid to who?
Well, that's to run the DST. So now you've got someone, you'd have a board or someone running. So instead of the bank dealing with each individual investor and a tenancy in common, right, they would have the DST, whoever's running the trust.
Right.
And so that'd be for the person running the trust.
Okay. So that would be actually the manager of the trust.
Well, the trustee could be, hiring the property manager and taking care of the taxes and doing...
Well, how does that benefit our viewers as we talk about this today?
Well, because right now a lot of people are in a situation where they bought real estate at a relatively lower value. It's gone up in value, but they may not have the energy or want to stay where they are, and the prices are pretty high right now. So people want to dump that property and take the cash out of it, but they don't want to be hit with 25,
well, they definitely want to get they don't want to get hit with the capital gains tax. There is an exemption on the sale of your property. You have an exemption every 2 years for that.
But that's your primary residence.
Yeah, it's your primary residence. But if this is not a primary residence, you get none of that.
Right.
And then on top of that, you got the 3.8%, the Affordable Care Act tax that's going to go on top of that.
Right.
So now you have a double whammy.
3.8%.
3.8%. Yeah, 3.8.
Don't try to get away with that.
I can't get away with that 3.8. 3.8 is 3.8. Yeah, we know what that is. And next thing you know, it'll be 5.
Yeah.
And then it'll be 7. And then
but the thing about it is like also properties aren't as cheap as they used to be, so you may have to band together with several others in order to do a commercial property. Where you might have been able in the past to go, okay, I'm going to sell this commercial property here, then I'll move down to Florida or somewhere in a warmer climate or wherever I want to move down to, and I will, do it on my own. But people can't afford, everything's gone up. So you might have to band together with 9 other people in order to afford that property.
So in reality, this benefits people that used to before be able to do this.
Right.
But now because of the value of the properties escalating because of the real estate values generally.
Right.
Now you can have more people still be able to take advantage of those real estate opportunities.
And also the timeliness. I mean, maybe you couldn't find something in 180 days on your own. Right.
Well, that's a whole other problem.
Right.
That's why
and see,
before you sell, you better already be thinking about where that 180 days, where you're going to be able to place the money.
See, when people are forming these DSTs, you might delay the sale of your property or speed it up so you get in with this next batch.
Right. So, and in that case, then there's.
And then here's another thing: if you were just going to buy, like a single family property, so here if you buy an apartment building, you might get a higher return on investment than you otherwise would if you buy them together with 9 people. Your money can bring you more.
Well, you should be able to have a higher buyer power if you're able to have a larger group of people.
Yes, and also you may be able to get a higher return on your on your investment.
Can the small guy do this?
Yeah, small guy can do it.
So that means a small guy, maybe with $100,000 or $50,000, could actually band together and make this something like that happen?
That's probably not enough. You'd probably have to be, you're better off being in the $1 million range.
Okay, so a small guy can't really benefit from this.
Well, a lot of small people, they're selling properties that are worth $1 million, but they can't move down. And it's like, say, if you got together, you could have 10 people with $10 million. Yeah. And then you could get an apartment complex. You get a pretty good rate of return on your investment.
Right.
And then that's for your retirement. So that's what people are looking at for.
Okay, so most of this is for retirement benefits, and I take it.
Well, I mean, that's where people are that have properties they've had, and maybe they were managing it themselves, and they're tired of collecting the rent. They're tired of being the property manager, tired of maintaining the property. And they want to throw in and have an apartment complex where they have a manager do this. Now, you may be able to do it for less than $1 million. That's true. But I'm saying, in general, properties are pretty expensive, and they're probably looking for people,
Well, you're going to want to have a commercial property that has a high rental value, so you can have it generating the rental income from the property.
Right, and you probably
that's number one. You got to be able to split that between the group that does that.
And also, so looking back in 2006, there was out of say 341 tenants in commons that were put together. There was, $3.7 billion in deals. So you look at these deals, and they're reasonably high value. So there's a fair amount of money in here. But it is, in a lot of cases, it would be a one-shot deal where someone was kind of, they want to retire and they're hoping to, live off this retirement deal.
Well, they're hoping to have a generated income per monthly that can keep them surviving.
Without having to worry about collecting the rent, without having to worry about evicting people, without worrying about doing maintenance,
Okay, well, so now so we're talking about a long-term holding of these properties.
Yeah,
these properties aren't for turnover.
Well, I guess you could. I mean, I have no reason you couldn't. You'd probably sell out your interest.
Okay.
But I don't think that's really what it's set up for.
It's really sold for a long-term investment. So the small guy can kind of figure this out, and if they can get themselves in on say they sold a property and they had $1 million of equity and were able to put it back in to something like this, they can be protected because they're going to have a management group making sure that the property's protected.
Right.
Okay.
And the money gets collected, and
they get their monthly dues as it's paid out, so to speak.
Monthly.
Okay, that's pretty good. Well, that's interesting. So I have a question, though. Is that good for every state in the union?
Yeah, you could form a DST and use it anywhere.
Okay.
You could use it anywhere.
Oh, well, in that case then, Mark, I think that was a really good subject, and I think we've called it for tonight. And I wanted to thank you tonight, Mark, for the subjects. A very interesting group of subjects. And I think what we have to do is look forward to the next month, and we'll have 3 more subjects for Law Talk. And I am sure we'll be able to raise some interest from the viewers.
Okay, well,
thanks, Mark.
Good to see you.
Good to see you again.